To talk more about the trading day in Europe, I'm now joined by Andrew Garthwaite, the global equity strategist at Credit Suisse. Andrew, thank you so much for joining us today. Now, of course, what dominated the headlines and all the news stories here on Bloomberg today was really this post-Dubai saga. Now, we have had assurance from the Central Bank of the UAE saying that it stands behind the banks, but it doesn't mean it stands behind, of course, these companies. First of all, is there a concern that this bad news may spread?
Well, clearly there's been that concern in the market since Thursday. Our own belief is that investors are in danger of exaggerating the impact of a standstill of Dubai world debt. Very simply, if you look at the data, it suggests that there's about $22 billion of foreign currency liabilities of non-UAE banks, and that represents only about 4% of pre-provisioning profits of US and European banks, and indeed only less than 0.1% of their combined asset base. So although initially some of the numbers talked about are pretty big, numbers in the press up to $80 billion, we think actually when you go through the numbers, they're a little bit smaller. $22 billion.
Andrew, I wanted to ask you also about the impact, of course, it's had on the markets today. Markets today here in Europe are lower. Now, a lot of strategists have said that because the rally we've seen in the last couple of months, investors and the markets are just hoping for an excuse to start selling stocks. Is this going to be the excuse?
Well, I mean, you know, there are always lots of excuses. I mean, in my mind, there have been 3 events in the last couple of weeks which have made people participate in some modest risk reduction. One has been the general increase in credit spreads. So we've seen sovereign credit default swaps in Japan double. The second is bullish sentiment has fallen, at least last week, to the lowest level since June 2004. And the third event, of course, has been Dubai. If you combine that with the time of year, and particularly the fact most hedge funds want to shut up shop and start to put on risk only in January, then there are lots of excuses to take risk. But I don't really want to be taking a market view on the basis of what's going to be happening in the next week. I think we should be looking on a 1-quarter view, or dare I say it, on a 6 to 12-month view.
So, Andrew, talk me through your sector strategy. What do you see as most risky? What kind of asset class would you stay away from?
Well, I mean, put it very simply, I think the anomaly is not so much in sectors at the moment, but in style. And what we find is the most risky is high financial leverage. At the beginning of the year, we found that high financial leverage was on the lowest multiple on record, and now stocks with high financial leverage are particularly expensive, and the converse, quality growth, at the beginning of the year was very expensive, now it's abnormally cheap. So high financial leverage you should be avoiding, and you should be looking at quality growth.
And overall, you prefer equity to credit. What would make you change that?
Yeah, good point. If I thought we weren't going to get a sharp pickup in cash-financed M&A.
All right, Andrew, thank you so much for that.